Hello, everyone. Welcome to our webinar on the new innovation sleeve in our GTBT strategy, which is a long-short absolute return strategy. First, a few words about our firm. So BCAP was founded in 2020. Its mission is to offer innovative and personalized investment strategy. BCAP is registered in Quebec and in Ontario. We are passionate about macroeconomics and strategies driven by quantitative approach. Today, our speaker will be Mathieu Boutier, which is the founder of BCAP and the CIO. He holds a master's degree in economics and the CFA designation. Before founding BCAP, Mathieu worked at JP Morgan in research and at BMO. We hope you enjoyed today's webinar and feel free to ask any question via the chat box. Mathieu, I hand it over to you to start the presentation.
Great, thanks, Felix. Hello, everyone. So today we will talk about a profound change we've made in our GTBT investment strategy. I will present the economic landscape that made this transition what we believe to be a very significant market opportunity. So let's kickstart with our team. So as you can see on the screen, 4 professionals and entrepreneurs spearheading this firm. As Felix mentioned, founded in 2020, close by Montreal. And so the firm is registered here in Quebec, but in Ontario as well. GTBT is a global macro absolute return strategy, and it has delivered interesting return and risk attributes since launch. And so it will celebrate its 5th year track record in January. So this is coming fairly soon. Very low correlation to benchmarks and peers, very low downside capture, yet providing upside capture. It is diversified across various types of exposure, and the investment philosophy is to deploy the strategy according to our macro reading, and macro is a fairly large concept which might incorporate commodities, geopolitics, innovation, so on and so forth. So effectively, the strategy carries a long book and a short book, predominantly comprised of put exposure. Essentially, the put acts like an insurance policy, and the nominal value of this insurance policy has averaged about 100% since inception. Although adjusted for the option beta, the net exposure of the strategy since inception has averaged roughly 50-60%. Towards the end of the 3rd quarter, it became clear that the tailwinds behind international markets, despite their appealing valuation discounts, was incurring increasing risks, and these risks were coming to potential benefits towards U.S. assets. And what became as a mantra, "Make America gainful again," turned into a playbook. And essentially, we accelerated the transition of the international sleeve into what we call the innovation sleeve throughout the month of November. So effectively, the sleeve is representing roughly 40% of GTBT as we speak. And innovation with a capital I is similar to a stock or an equity factor. And like any other factor, you need a set of macro conditions for this trade to gain traction and generate interesting returns. Here are 5 of the key stars that are aligning as we speak. The first one is an improving capital markets backdrop and rising animal spirits, investors' participation into riskier assets and willingness to embrace that sort of risk. US elections outcome seems to be paving the way also towards increasing participation into innovation. There is global demand for enhanced productivity, and as we speak now, the global champion leader is by far the US economy, with an annual delta or differential of somewhere between 1.5% to 2% expressed as a percentage of GDP versus other developed economies and emerging markets. And these R&D investments might actually accelerate. Soft landing is a pretty strong requirement. So here meaning that the economic expansion must be just sufficient to incite risk-taking and capital expenditures and to sustain consumer consumption, yet must not be too hard so to accelerate inflation. And finally, this is something that has been contemplated for several years now, but is gradually coming together, is the conversion of all these different tech-driven innovation. And you can now sustain the idea that one might drive the realization of another, not only in terms of technological breakthroughs, but also in the way these technologies are now being channeled down to the end user at an increasing speed. Without further ado, some quick charts sustaining those 5 stars we just talked about, which put together provide us comfort that actually this might be somewhere between the 3rd and the 4th inning, talking in baseball terms, referencing here the resurgence of highly innovative, disruptive technology stocks. What you see on the screen are 2 stock indices. One, the recently IPO'd US companies, and the other one, those companies that came to the market through SPAC. So there has been a quiet zone for a bit longer than 2 years, and it's only more recently that the price action in those companies has broken resistance. This is coming at a time when actually IPO activity is coming out of the dead zone. So there's been a severe crash post the 2020-2021 market craze. Like most things, there is also a concept of pent-up demand. So just with time, actually, companies will need to come back to capital raising through equity or credit, and this is happening as we speak. And not only IPOs are making a comeback, but additional equity raising has also made some pretty significant leaps, and this is critical for the next leg of those companies that will require capital to gain traction with regards to their research and development and bringing products to the market. In terms of willingness to lend, the Senior Loan Officer Survey has moved in the right direction throughout 2024, and we expect actually 2025 to continue. This has already been observed in terms of contracting CCC credit spreads. And we believe that there is further room for those very high yield, riskier spreads to contract over the next 12 months, both explained by the credit spread compression, but also with a few Fed rate cut over the next 12 months. Now, after here too, a bit longer than 2 years in the penalty box, we've seen a resurgence of the lowest quality quintile companies here, exhibited by the thick red line. And the innovation stocks, here depicted by the ARKK ETF, have taken note, and most likely the most innovative companies will score poorly in terms of financial fundamentals, whereas therefore access to capital is a prerogative. Now, the election red sweep has been phenomenal. Trump has been active over the last few weeks in terms of nominating not only successful entrepreneurs, but very wealthy ones. And this will be the wealthiest administration of all times, of all regions. And here on the slide, you see a few examples. So the newly created Department of Government Efficiency, led by Elon the Great and Vivek, one of Elon's friend, actually, Jared Isaacman, has been nominated to head NASA. And then you have people from the financial services community, hedge fund manager Scott Bessent, nominated to be the next Treasury Secretary, Cantor Fitzgerald CEO for Commerce. And the list goes on. He has also suggested appointing pro-deregulation individuals such as Paul Atkins, who has been a very vocal crypto advocate, and announced yesterday, actually, David Sachs to be the next White House AI and crypto czar. And so this is a very Trump-esque nomination. Mr. Sachs is a PayPal co-founder and one of the most successful VC entrepreneurs in the world. And the soft landing is in the cards, we believe. And so there's here depicted on the screen are the GDP nowcast and the inflation nowcast measures. And effectively, over the last 12 months or so, real GDP growth on an annualized pace is hovering around 3.5%, and inflation is fairly stable around 3.5%. And there are good reasons to believe that inflation actually will tame down as anticipated by the bond market and the bond vigilantes. So here showing the break-evens, which are induced from tradable instruments, nominal and real yield liquid instruments. Now, it might not be perfect, but nevertheless, it's been a few quarters now that inflation forecasts are hovering around 2.5% for the foreseeable 1 to 5 years, and that will be in the sweet spot of the Fed. The job market has also shown sign of normalization. Here in the bottom panel showing the job opening to unemployed ratio, now back slightly below pre-COVID levels, yet remaining strong enough to convey the signal that this economic engine is performing well. PMIs also have a fairly high likelihood of confirming a reacceleration of the US economy. And the way this type of survey is constructed, being diffusion indices, it's a matter of time before the next 3 months will be expected to be stronger than the previous 3 months. And so this is the way that the surveys are being constructed. And effectively, as we see in the upper panel, this contraction pause has been fairly long based on historical empirical evidence. And in the bottom panel, what we see is an interesting leadership from new orders, which is a good omen for an upward resumption of production. And similar patterns have been observed in 97, 2017, and towards the end of 2020 as well. Consumer confidence, similarly, is not starting from an exuberant point. It is actually right about at its long-term average, shown on the bottom panel, which is the sum of the Conference Board and University of Michigan consumer confidence measurements. So this provides confidence, once again, that there could be further innings to confirm further price appreciation in what we have called the innovation trade. The return of the invisible hand might also suggest that there is a floor. So Trump put, as well as the Powell put together, suggest that there is here too further upside to this trade on the chart showing money supply in the States, which has only recently fallen back into its upward rising channel, which tracks a logarithmic growth pace. The main innovation themes that we have targeted are AI, crypto or digital assets, genomics, which is a subset of biotech, automation, which is better appreciated in the manufacturing, but also the transportation industries, as well as clean tech, which will incorporate energy storage, batteries, etc., e-commerce, space, which incorporates satellites as well as space exploration and infrastructure. And finally, financial technology, coined fintech. Each mark on the screen represent a specific issuer in which we have invested. Only one of those marks is comprised of an exchange-traded fund, an ETF, for a specific industry where the specific issuer risk was too great to take, and better spread out through a very niche ETF. The blue squared check marks are actually very recent positions, more recently initiated throughout the phase-in of the innovation sleeve. 3 case studies quickly. The first one is the world leader in voice AI, which, as we speak, has a 5 billion market cap. It can count on very strong partners in the space, such as OpenAI and Perplexity. It also has NVIDIA as a shareholder. It has north of 150 granted patents, and monetization is actually just kicking in. The total addressable market is gigantic, 140 billion as we speak, and set to increase at a very fast pace. And they will make leapways into this addressable market. And this, on top of their accelerating monetization process, means that they will be able to keep the 50% growth CAGR they have witnessed over the past 5 years, over the following 5 years. And good examples of customers are the automotive industry, as well as the restaurant chains, who will be able to deploy voice AI in order takings. And already there is empirical evidence that actually not only is it working, saving time, increasing accuracy, but also upscaling the ticket size, which is an interesting feature for the end client. And why AI? Actually, here showing that not only is AI accelerating, but the acceleration is itself accelerating. And the input, so the number of parameters feeding up AI is off the chart. And the output, so here expressed as the time it takes to develop some sort of a human level achievement with regards to separate capabilities, has accelerated from 12 to 3 to now 1 to 2 years. Second case study is a sub 2 billion market cap company, yet a space technology leader with real contracts, billion-dollar contracts from the NASA agency, very strong backlog, and has recently been appointed as the supplier for a constellation of lunar relay satellites. And with what I've said previously, with the type of domination, Elon Musk now closer to the White House, I think we're going to see over the next 5 to 10 years very significant infrastructure build-outs on the moon, which will serve space exploration and the rest. Now, third case study, we took 2 positions in Bitcoin miners and other crypto assets, including the largest publicly traded miner, which not only is improving its own mining capacity, but also diminishing its cost structure. in part due to its appealing investment in renewable energy. And so at the margin, investing in wind infrastructure is very compelling. Also because the marginal cost to build out further capacity is very lucrative. And as we may appreciate on this chart, here showing select ETFs, the top one is the S&P 500, which has worked out phenomenally well, above expectations over the last 2 years. Yet in the bottom section of the chart, you have highly innovative, disruptive value proposition, such as genomics, software, automation, and the likes. And we believe that there's further room to grow and to appreciate. And in a sense, this was a quick review of why we thought that November marked a turning point, and that actually this is not the end of this innovation trade. It's not too late to join in. We have made extensive work in selecting the best value proposition. And if you have any further question, please feel free to reach out. Thank you.